Hi guys, this is our first video for chapter 5. Today we're going to be talking all about assertions. So I hope you're excited. Alright, so today we're really focused on assertions. This topic, assertions, is really designed to be an entire day's lecture. So we're going to talk about them first. Then I have an exercise that I want you to go through and do. And it'll take a little bit of time as well. So in terms of assertions and how they relate to the financial statements and the audit report, which we're already familiar with, let's talk through that. So we know management gives us the financial statements, right? And management is responsible for the financial statements. What we didn't really talk about so far is this idea that those financial statements, when management gives them to us, they basically contain a lot of implicit assertions regarding various components of the financial statements. Okay, and so if we look here, that is the official definition of assertions. There are these expressed or implied representations by management regarding recognition, measurement, presentation, and disclosure of information in the financial statements and related disclosures. So let's talk about what that really means with some examples, right? So when management hands us a set of financial statements, we look through them, right? There's a bunch of numbers in there. So we have a number like cash. When we see that cash number, we assume several things, right? We assume management is telling us that cash number exists, right? That cash is actually in the bank. We assume management is telling us cash is complete. There's not other cash accounts out there that should have been recorded that aren't. We assume management has done any currency translations that need to happen, that they've happened accurately. Any kind of valuations in the financial statements are correct. We assume that cutoff has been performed properly, right? We don't have any of next year's transactions in this year's financial statements. So these are the types of things we're talking about. We're saying the financial statements contain all these expressed or implied representations by management. So in terms of the audit procedures, which is the step here, so far when I talked about audit procedures, I really talked about us doing them kind of on an account level. Right? So I said, we'll do audit procedures over cash, we'll do audit procedures over AR, audit procedures over AP. But really, the detail I didn't get into was audit procedures are actually happening at the assertion level, right? Which is more granular or low level than the account level. So technically, when I do an audit procedure, I'm doing it for cash existence, right? I want to specifically test that cash exists. Or I'll have another audit procedure that helps me test that cash balance is complete, and another that helps me test cash is valued properly. I have all these various assertions that we've assigned to all these different accounts. And basically the idea is they're going to provide me with a roadmap for what audit procedures I need to perform. It's going to help give me some confidence that I've essentially covered all my bases. That way, I know when I have done all my audit procedures, I have sufficient evidence to give an opinion on the overall fairness of the financial statements. So I'm able to reach a conclusion and ultimately issue my audit report. This slide, right, was just our formal definition of assertions. And it's just reminding you that, remember, management is the one responsible not only for the financial statements, but the fair presentation of everything in the financial statements. And they're really responsible for all these individual assertions too. So let's talk about what all the assertions actually are. They fall into two categories. So the first are referred to as assertions about account balances at period end and their related disclosures. I personally think the easiest way to think about these are balance sheet disclosures. These are basically assertions that cover asset, liability, equity, account. And you'll always hear them talking about these account balances as of a specific point in time, right? As of a specific balance sheet date. The other type of assertion is assertions about classes, transactions, and events for the period under audit, and also their related disclosures. So for these, I think the easiest way to think about them are to kind of think about them as your income statement disclosures. And of course, they're your statement of cash flow disclosures too. But I kind of feel like the easiest delineation is to think about these guys as your balance sheet disclosures and these guys as your income statement disclosures. So these will be assertions over accounts like sales, accounts like cost of goods sold. So now we're going to dig even deeper and talk through the various assertions. So the first assertions that we're going to talk through are the assertions concerning account balances at period end and their related disclosures. So in other words, the balance sheet assertions, as I like to call them. So the first two I would like to talk about are called existence and completeness. And these are really opposite of one another. So existence is the assertion that assets, liabilities, and equity exist, whereas completeness is these accounts that should have been recorded have been recorded. The reason why I like to talk about these two together is because this is the point where people get really confused because they think existence and completeness basically sound like the same thing, right? These two concepts sound super similar. But in fact, when we talk about them in this audit context, this assertion context, they are essentially opposite. To help us talk about these, I'm actually going to pull up an example inventory listing. This is from the same company that kind of your Tableau data is coming from, this example inventory listing. So it has kind of the date the inventory was purchased, the description of the inventory, its fair market value, the product number, number of items, sales price, unit cost. This is all the inventory they have. And so you see there's totals too. So this is the total value at cost. This is the total value at market of all the inventory. So presumably this company is recording things at lower of cost or market, right? You know, that's what they're supposed to be doing. So this number should be what is reflected on the balance sheet, assuming this is all the inventory the company has. So to go back and talk about existence now, if I want to, as an auditor, test the existence of this inventory, I want to prove that this inventory exists, that these particular assets exist. The way I would do that is during my inventory observation, of course, I would pick items from this list, right? Because these are items that have actually been recorded. So for instance, I would pick the bolt hooks, the American Lock laminated, the solid braid nylon. So I pick these items at random and I asked to see where these items are in the warehouse, right, during my inventory observation. And they should be able to show me exactly where these items are. And I should be able to validate the fact that for bolt hooks, there are 135 of them. And for laminated lock, I should be able to see there are 77 of them there, right? That is the proof of existence. So remember, for existence, I am looking to see that something actually recorded on the books already exists in real life. So the risk here really with existence is overstatement risk. I am worried that they have recorded something on the financial statement that does not exist. So I'm worried about overstatement. I am worried this number here is too high. So the way I'm going to prove that these items do exist is by going from items on the list out to supporting documentation, right? Which the supporting documentation for an inventory observation is going to be finding the actual physical inventory itself to validate that these items really do exist. So that's existence. It's going from items in the record out to supporting documentation. The risk is really all about overstatement. I want to make sure things in the financial statements do exist in real life. Completeness is the opposite. So what I'm worried about with completeness is that there are things out there that should have been recorded in this list that are not recorded in this list. So this is really the risk of understatement. So in order to test that in something like an inventory observation, what I would actually do is I would physically go roam around, right? I would roam around the warehouse and I would pick items at random that I physically see, and I would say, hey, show me where this item here that I can see in front of me, show me where it is on my list, right? Where is it on my list? Because any item that I physically see here should be on my list if my list is complete, because presumably if it's not on my list, that would imply my list is incomplete. So that's kind of the idea with completeness, right? And if my list is incomplete, what does that mean? It means my list is understated, and ultimately is going to mean this balance here is too low. So for completeness testing, you're typically going to go from the outside, right? From supporting documentation or from the physical items themselves in an inventory observation, and you're going to work backwards back into the financial statements, right? Or the financial records, because I'm going from the outside items, coming back into the financial records and saying, hey, show me where they are in the records. Show me where this item is recorded. So that is existence and completeness, right? So remember, these two are opposites. Existence is typically overstatement, completeness, understatement. Rights and obligations is the next one we're going to talk about, the next assertion we're going to talk about. Rights and obligations is generally all about who actually has legal rights or legal obligation to an asset or liability. And when I say legal right or legal obligation, I'm not talking about, right, the existence, completeness type angle. I'm talking about, for inventory example, this would be things like, are the goods held in consignment? Things like that, right? So with consignment inventory, you could, in theory, have goods that are physically located in your warehouse, but you don't actually own the goods, right? Somebody else owns them. That would be consignment in. Or you could have consignment out inventory, which would be, hey, I actually do own inventory, but somebody else has physical custody of it, right? So that's what the rights and obligations angle is all about. Who has actual legal right or legal obligation to a particular asset liability. Valuation and allocation is our next assertion, where existence and completeness, right, are more about the quantity being recorded. Like for inventory, was that quantity recorded? Valuation is really about the dollar value recorded, right? Is the dollar value recorded correct? So for instance, is that inventory recorded at lower cost or market like it's supposed to be? You know, if market value has fallen under cost, we should have some kind of reserve for that. So those are the types of things you want to consider for valuation. For classification, this is all about, have things been properly classified and recorded in the proper accounts? So think about investments, right? Are they available for sale or are they held to maturity, right? Or is my debt appropriately classified as short-term or long-term? For presentation, the presentation assertion is all about things being disclosed appropriately, right? So things should be properly aggregated or disaggregated in the footnotes. They should be clearly described, And the footnotes and footnote disclosures should be clearly understandable, right? So it's also, the footnotes should be, when I say understandable, so they should also be transparent. We saw sort of a research study at Baruch where it tested the reading level of the financial statements, and it found you basically need, a PhD to be able to interpret the average company's 10K. So it really should not be like that, ideally, right? They should be understandable by most reasonable users of the financial statements. So hopefully you remember all those balance sheet assertions. Keep them in mind, because we are moving on to our assertions about classes of transactions and events for the period under audit. So another way, as I said, another way to think of these is kind of as your income statement and statement of cash flows assertions. So again, we have, as the first two, we have occurrence and completeness. And I'll be clear, so occurrence is essentially exactly the same as existence, except occurrence is just the class of transaction version. So that's why I have occurrence equivalent to existence. And on this slide, the prior slide, I had existence equivalent to occurrence. And you'll actually see in the audit firms, I assume all of them do this, certainly EY does this, when they list out the assertions in their audit documentation, you'll see them call this assertion E/O for existence/occurrence. So they are truly equivalent to the same thing. Occurrence is just making sure things exist, right? Transactions and events during the period that have been recorded did occur and they pertain to the entity, right? So once again, it's looking at things that have been recorded, right? They're already in the records, making sure they did actually happen, right? They do exist. It also has completeness, right? So again, all the transactions and events that should have been recorded have been recorded. So once again, we see this one is really concerned with overstatement, right? We want to make sure the stuff that has been recorded should have been recorded. And this is really concerned with understatement. We want to make sure the stuff that should have been recorded was recorded. So moving on, we have our next one, which is actually unique to classes of transactions and events for the period under audit, which is authorization. And it's just this idea that all transactions and events should be properly authorized. So this covers things like all sales should be authorized, all payroll transactions should be authorized, right? So all payroll checks that are handed out should have a signature. And you'll see things like there should be an authorized price list, right, for customers. And customers' credit should be authorized. So you can see it's very transaction related, right? Sales should be authorized. Purchases should be authorized. Accuracy. So accuracy from a class of transactions perspective is very similar to the valuation assertion that we saw here in the balance sheet assertions list. So accuracy is just making sure that amounts and other data relating to recorded transactions were recorded appropriately, right? So, okay, let's say we have a sale that was recorded. So the sale itself to that particular customer did exist and should have been recorded, but let's say the dollar value, right, the unit price that the items were sold at, that was recorded slightly incorrectly, right? That might be a risk, right? So very similar to that valuation concept. For cutoff, so cutoff again is a unique assertion to the class of transactions. So cutoff is about things being recorded in the correct accounting period. So with things like cutoff, we see We're usually concerned essentially with the transactions that happened in the last couple weeks of the year and the first couple weeks of the new year, right? So the last couple weeks, if we're auditing fiscal year 2019, we're concerned with the last couple weeks of December 2019. And we're also concerned with the first couple weeks of January 2020, right? Like what is going on with the transactions in those periods? And we want to make sure basically that all December fiscal year 2019 transactions are appropriately accrued for and recorded in 2019. And all things that really relate to fiscal year 2020 are not being recorded until January. So this would be where things like shipping terms become really important, right? Because you can have sales, say, on December 30th, December 31st, shipped out, but they are shipped FOB destination. So if you have sales shipped FOB destination those last few days of the year, they may not have actually reached their destination by fiscal year end. And in that case, you're not supposed to recognize revenue, but a lot of companies do. It's actually a very common error that I personally saw when I was auditing. And just to refresh your memory, in case you don't remember all your shipping terms from your early accounting classes, FOB shipping point is when the ownership transfers to the buyer upon shipment, right? And in that case, you can recognize revenue upon shipment. FOB destination is when ownership transfers to the buyer upon receipt, right? When the goods actually reach the destination. And in that case, you're not supposed to recognize revenue until the goods actually get to where they're going. So I could feasibly be shipping things in December that don't get there until January, and those are really January sales. And other things to think about would be things like payroll, right? You could have people getting paid in January for hours they worked in December, right? We want to make sure we accrue that payroll expense, right? Because the expense itself is related to December. So we think about all those things with cutoff. Classification, right? We saw classification and presentation back here. So we're just seeing the same two again. So this is transactions and events have been recorded in the proper accounts, right? So from a class of transactions perspective, for an example, we want to make sure things like specific expenses are properly classified as SG&A versus COGS. And then for presentation, for that assertion, we have the same kind of concerns, right? We want to make sure transactions and events are being properly aggregated, disaggregated, clearly described. We want to make sure footnote disclosures are understandable. So those are our assertions about class of transactions and events under the period. They are very, repetitive for the most part of the balance sheet assertions, apart from authorization and cutoff, which are kind of the unique ones.